Welcome back, Luis. So, in the last episode, we talked about luck and skill. We talked about Bayesian thinking, and we talked about type 1 and type 2 errors, right? Now, I'm going to continue this discussion on type 1, type 2 with the following things. You mentioned that one of the ways to kind of manage this error is also to diversify. And I'm going to read one interesting quote by Charlie Munger, late Charlie Munger, in his Berkshire Hathaway
I know the
annual
quote.
meeting. Yeah, okay. So one of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. That is an insane idea. It's not that easy to have a vast plethora of good opportunities that are easily identified. So the point here is that, do you think that like publicly listed stocks, is it also relevant, in the life sciences world, private investing, that the good opportunities are not, a lot, it's very few.
It is correct, but nevertheless, I very respectfully disagree with Charlie Munger here. I admire the guy a lot, but I think this comment in my world does not work. I need to diversify. And I think all investors will, or the majority of investors will tell you that you need to diversify, especially if diversification in our sector, it's between 10 companies in your portfolio, because Charlie is talking here about investing in the stock market, and sometimes they have hundreds of assets, So it is true that if you have a high conviction on the potential outcome of a company, you will try to diversify as little as possible. In that, I can agree, but I wouldn't bet my whole fund in one company. I need to make it.
Of course. Absolutely.
Maybe 10 companies. There are other funds that diversify in 50 companies. That I don't agree, because my bets are high conviction bets, right? Or investments. However, as we were mentioning in the last episode, I mean, luck plays a role. There's a lot of noise. Things may happen, market downturns, different situations for pharma that are potential acquirers of your company that now cannot acquire, whatever, right? So you need to take that into account, and the only way of doing that is diversifying a little bit at least.
Absolutely. So in terms of diversification, can I ask you one question? In venture capital investing, especially, so when I invest in a publicly listed stocks, right, my returns, or let's say the outcomes, are not that power law distributed, meaning that, so just to explain the audience, that power law distribution means that, there are 3 or 4 outcomes, that really, kind of define the whole distribution, So in case of venture capital,
outliers, if I may interrupt you.
Yeah, sure.
They tend to be outliers, yes.
So in this case, are you not looking at those outliers? And if you're looking at those outliers, would you agree that, let's say in biotech investing as well, it's your 3 to 4 deals that really provide you the returns rather than 5 or 6 that might completely fail?
Absolutely. Yes. That is exactly correct. Let's start by saying that in our industry, an outlier, it's a very large sale, right? Typically. And so outliers in a way are a blessing for us, right? But it is true, if you do the math, let's assume for a second that one fund, I don't know, it's a 150 million fund, and they make 10 to 12 investments, okay? That would be a typical fund, okay? In this type of fund, if you get 2 exits, probably you give back money to your LPs. If you have 3 exits, then you have a very solid multiple, and anything above 3 out of 12, let's remember that. So we're talking about 25%. It's an amazing return for your LPs, because the level of investment that we do, and in our case even more, because we invest very early, we tend to invest in companies at a low pre-money valuation, because the risk is very high, right? So exactly. It turns out to be that selling 1 or 2 companies makes a great return. If you sell more than 2, then you are like the king in this fund, right? Because
exactly.
really paid off.
Exactly. So, as you talked about this return of funds, maybe there is a small digression which I have not prepared, but I think it will be important for the audience to know, because most of the entrepreneurs, when they build the company, they're building the companies, right? They have to start thinking like an investor, because what happens is that they are focused mostly on the value. That okay, how can I maximize my pre-money valuation and so on. But I think it is very important for them also to understand how do you operate. So first question to you is that, does the size of the fund matter when you invest? Meaning that, if your investment is 500 million versus 150 million, will does it how does it change your perspective with respect to investing? That's my first question. Maybe we can take this and then next.
Yeah, there are like two questions in your question, I think. First, when you mentioned that that entrepreneurs need to think like an investor, yeah, I mean, they are looking into the pre-money evaluation of their company, for example, but they need to look at the equity story, the whole story of the company in the future, right? Because if now the pre-money valuation is too high and we inject a lot of money and after the deal is done, then we have a post-money valuation that's too high for the stage we are in. When the time comes to raise again money, maybe you will need a down round or something, because and it's a very bad news for a company. So it needs to be in the window that makes sense, and that is something that entrepreneurs sometimes don't understand, right? This is to answer the first part of your question, and of course the ticket size matters, and because the ticket size is heavily influenced as well by the stage at which you're investing. If you're investing, for example, very early, maybe your ticket size is 1 or 2 millions, but these 1 or 2 millions have a lot of value because they have been invested at a very low pre-money valuation, right? So classically, very large funds, like 1 billion funds plus, right? They invest more late because they need to deploy a lot of capital. And
Exactly.
by they invest, the return on their investment at that stage is lower because they invest already in a company that has a large pre-money valuation. So if you do the math, you will see that investing early actually is very interesting. But you need to know how to invest very early because it's not an easy space. But yeah, you're right. The ticket size matters and it conditions your strategy for sure.
So maybe it is not easy to conclude, but can we say that, it's harder for larger funds to give returns back to LPs than smaller funds because, of various factors? One is that, my denominator is very large right now. I have 1 billion.
I wouldn't dare to say this because it depends. I mean, all I'm saying is not that they have less or more return one fund or the other. It's about they need different strategies. Okay,
Correct.
You cannot make money in a fund that invests tickets of 50 millions, right? By investing super early, or you need a special strategy, and the opposite is true as well. I mean, if you have a small ticket size, you need to know at what stage you are investing. So I wouldn't dare to conclude that, but I can tell you that yes, the strategy is paramount for the fund to make money. Yeah.
Got it. Perfect. Super. So in rule number 30, you talked about normal distribution. And if I look at, let's say, if I discuss, I'm sure normal distribution has its own place. But if we look at the licensing deal values, and as we discussed, before starting this interview also, is that most of the deal values, not most of the deal, a few of the deal values, in fact, if I plot all this, it's a powered or distributed. So when you make a decision on whether I should invest or not, and when you decide that, yes, can I exit or not, if I can exit, I'm sure you'd like to be in that outlier part, right? In comparison to this one, right? And I think that should be the basis of the investment. So the point, my point is that how do you like entrepreneurs to kind of pitch to you, especially about when you have to provide comparable deal values, right? So one of the ways that, okay, I can pick up, comparable deal values in XYZ area, and let's say put all the billion-dollar deals, which are not many, they're just 4 or 5, maybe 7, right? It's of course nice to show, but then, if I come with this particular pitch, then how do you think, apart from that science is good, what are the factors that really drive you to think that yes, this pitch has a chance to be an outlier in licensing deal values? I'd like to understand your thought process.
That's very interesting. Let me start by saying that billion-dollar deals are clustered among specific indications and modalities. Okay, it's not just an outlier and nothing else is playing. I mean, of course, I cannot explain my own models because this is their information precisely about the fund, right? But I can tell you it is not luck. I mean, these analyses, these outliers are not evenly distributed among all companies, okay? You can find reasons behind that luck, as we were discussing in our previous episode. So how do I like the entrepreneurs to pitch this? Of course, I try to invest in companies that have more chances for an early liquidity event, precisely because of what we were mentioning. Of course, early liquidity events are typically in the low 3-digit space, right? 100, 200, 300 millions. And you may think, but that's not a deal that, well, if you compare it to the amount of money that you have invested, remember it's early, the multiple is actually very interesting. You give a very high multiple for this. If you need to wait until the end of phase 2, for example, or even phase 3, then the company is sold by this billion type of deals that you're mentioning, but then you are heavily diluted into the company because the company has needed a lot of money. And typically, in my math, in our way of investing, early harvest is typically more interesting than late harvest. Of course, every example is different. You may find examples where this is not the case. However, statistically speaking, believe me, in my own modeling of this is the case. So we try to favor early liquidity events, and therefore I like the entrepreneur to pitch this, showing us examples of early liquidity events having happened in this particular modality or this particular indication that the entrepreneur is trying to work on, right?
But one interesting point that I always get is that we cannot time that liquidity event, right? Of course, you can, engage with the pharmaceuticals and all that, but when that liquidity will happen, it's very hard to tell. Although in the pitching, I could say that, okay, my plan is to develop till phase 2A proof of concept, and then, I would like to kind of, exit.
Yeah. Yes, but in order to increase the chances of making this happen, meaning an early liquidity event, what I focus more is on a couple of things. First, prepare the company for early business development conversations. That means maybe hire one that is able to start very early in the process interacting with farmers, because even if they don't acquire you, they give you information that's precious for the company, right? I mean, so I would recommend always to start very early business development. And the second thing is I plan very carefully for the independent directors that we bring to that board, because we need people precisely that have the connections, that have the network, that have done this in the past, and that can open doors. So, for example, I don't know, in my companies, I'm gonna name drop a few independent directors just for you to notice the quality and the amount. For example, in one company, the chairman is George Church, head of synthetic biology at Harvard, and maybe my hero. This guy is a legend. He created the synthetic biology space. And in another company, we have, for example, Tim Lu, which is he used to be the director of synthetic biology at MIT, and now he's the CEO of a very well-known company. Nasdaq listed. And he comes to the boards here to Spain, and it is a privilege to have him on the board. These guys are the ones that open up these opportunities to engage early with farmers, and I plan for this. Yeah.
Super, perfect. Thank you. Now let's go to your rule number 29, game theory. You talked about game theory. My question to you is that, does game theory really work in the real world, in the sense that I read that, the implicit assumptions are that, game theory assumes that we are rational. And then it gets me into the question that, how do you define rationality? Because we are actually, human beings are not rational, we are irrational, right? Most of the time. So that's my first question to you.
Yeah, I mean, to use game theory, you need to understand, I mean, why do we use game theory when planning for things, or when managing companies and analyzing problems and trade-offs and things? Because game theory directly applies to human behavior. You need to understand human behavior. Okay, it's not, as you say, it's not exactly rational. It is precisely the opposite. It's governed sometimes by emotion, sometimes by rationality, of course. But when you ask me, how does game theory play a role here, I would answer you with a counter question, if I may. I mean, it's exactly when you say, for example, a plan is nothing, but planning is everything. You know what I mean? I mean, the plan itself is not definitive. The moment you print it, it is outdated, classically, right? But nevertheless, having your mindset used to planning all the time makes a difference. So in this sense, game theory is not an essential thing that should dictate what you do at every precise moment of, I mean, we're not that obsessed with that, but the frame of mind of trying to incorporate human behavior into any decision, human behavior from the counterparts, it's very important. And yeah, I am a fan of game theory. I love the subject, and that's why I devoted one entire chapter to this. I think it's useful.
So when you gave an example, right, in which, let's say there is a company, and I think the example was like they were in discussion with a pharmaceutical company, and their cash was about to finish, so they had an option either to wait for the pharmaceutical decision, but if they had waited, then the cash would have gone. So, and I think everybody thinks in a different way. And when I was thinking, I have also been in such a situation in few of the biotech companies where I worked as a CFO. And my thinking was always built on the lines is that I have to survive first. That's how my thinking goes. So if I'm in that particular situation, and I'm just telling you my thought process, that okay, I would not think in terms of game theory. Maybe I'm not, let's say, of course I focus more on behaviors and everything, but my focus at that point of time would be that okay, I have to save the company first. That means that in order to succeed, the company has to keep surviving. So the best action course for me would be to have either a bridge round or minimum amount, let's say for 4 months or 6 months, so that even if the company gets an offer from a pharmaceutical company, I don't raise 30 million or 20 million euros.
That's exactly the case.
Right.
I mean, I very much agree with you on the sense that first and foremost, an investor, especially in biotech, at least in my experience, needs to be focused on preserving value first. I mean, the company needs to survive, and it needs to move forward, and it needs to get to the time window where an opportunity could come, but for that to happen, it needs to get there. So you need to be focused on preserving the value. I'm not a huge fan of super bold bets that risk the whole of the company. That usually doesn't work, right? However, there may come a time in the story of the company when a farmer, for example, presents a term sheet, then you need really to change your frame of mind and be on selling mode and trying to make that happen. And for that to happen, sometimes you need to take risks. However, as an investor, we try to de-risk to the maximum everything we do, because we know what happens when risk hits, right? You lose all the value in a blink, and that is not acceptable. So again, preserving value is important, but you need to be prepared to take the risk when the time comes. Yeah.
Perfect. So that leads me to one of the second last question about, so in rule number 18, you also discussed about how entrepreneurs should talk about their market size, and I'm giving you one real world question, and I would like to understand your view on that. So let's say, for example, there are certain markets when you look at that, okay, what is the market size of, let's say, for example, neuropathic pain, and let's say you get, something like, maybe 5 billion or 6 billion, something like that. Okay. If you do the math, meaning that, okay, how many treated patients are there, you get a price of like $600 to $700 per patient per year. Okay. Now, let's say, for example, a company comes to you and says that, okay, they have a very excellent phase 2 data. They have been able to cure 7 out of 10 patients or 8 out of 10 patients, for example, and you know that the drug works. Okay. So the point is that, if you use, let's say, any other pricing, for example, let's say 7, 8,000, 10,000, 12,000, you become the market, meaning that, you are more than the market size actually. So if you are faced with this particular situation, what are the things that, you should be? It could be a possibility that, the market they are disruptive, but we know ex post, right? When things happen, then we would be knowing. But at that point of time, when you have to make a decision, how would they convince the investors that yes, this could be, the market, the implicit pricing that is built on the past drugs that have not worked at all. It's a high unmet need. And the key opinion leaders have really seen that our drug works. So what would be your thoughts on this?
My thoughts on this are very personal, but again, they work for me. Unlike many other people, I don't give a lot of importance to the market size when deciding on an investment. And I know that may sound a little bit strange, but actually it makes a lot of sense to me, because actually market size typically correlates with the degree of crowdedness that this space has, right? I mean, if you go for a market, I don't know, diabetes, enormous market size, but how many companies are operating in that field? So and the chances of success as you're competing with a lot of people. So remember, this is a risk-benefit ratio, and not just a benefit decision, right? So I need to factor in the risk. So I don't really, in fact, I prefer smaller markets. They tend to work better for me, at least for my style of investing. And I focus more on something that you mentioned very well, Sora, which is high unmet clinical need. That is what drives my investments. I need to see that the need is really high, and even more importantly, it is unmet. There's no standard of care really working in that area. And even if the market is small, if I can provide a solution and change the natural history of the disease for those patients, I will have tremendous return, even if the market is not very big. So again, market size, of course it matters, but it's not one of the most important things that I look at when considering investing.
Got it. So in this particular case, also it could happen that, let's say, the current market is small, but it could become disruptive because it's a high unmet need, and maybe the price is reimbursed by, the payers, the new price, So, okay, got it. Perfect. So I think, we are almost at the end of our conversation, and while you have received so many decks from different different entrepreneurs, can you provide at least 2 or 3 points what they should not do when they present to you? Of course, what they should do is they have to read this whole book, but in what they should not be doing it, which is kind of a wow, this is, because it's easy to kind of talk about what they should do, but what they should not do is, kind of very to the point.
Yeah, that's a better question than asking for the things that they should do. Listen, there are things that are very clear, right? One has to do with clarity or the absence of it. I mean, if the information is not clear enough, that's a no-go, because what we're looking for is people precisely, especially the CEO, but the organization as a whole, that has very good communication skills. If the deck does not reflect these good communication skills, then it is speaking by itself. I mean, this team is not clear enough. They don't have clarity. Then making bold assumptions or bold statements without the proof is something that I hate. I mean, when some entrepreneur says, I don't know, some scientist says, this is going to cure this and this by a fact, I mean, we're going to change the natural history of the disease by this amount, the delta on the patient will be, but it is not backed by data. I mean, I don't care about your opinion. I care about the data. I mean, I say, show me data that supports that. So don't brag too much, because we're going to catch you. Okay. And finally, something that is usually never in presentations. I mean, we need to know your degree of, I mean, you need to show, excuse me, to convey the information in a way that I perceive that you are very savvy on this field. If I see on the slides that this is not, sorry for that, it was a call that I had. If I see you don't know much about the subject, then it is, I mean, you need to really know about what you're trying to do, right? And be prepared, because the investors, even if they don't know as much as you do in that particular subject, they can access the key opinion leaders that know a lot about this particular field. And we tend to be very technical, even if not being like the best in the world in that particular area that you bring into the market, but we are very technical. So be prepared for heavy questions, and you need to be really prepared. Don't show up unprepared. That's my third point.
Perfect. Thank you very much. Now, I'll just use the opportunity to ask the last question, although the last question was supposed to be the last question. And that is, it's a very general question, and which everybody keeps asking, but nobody has the answer, is when the market crashed, I know I had this always opinion that we human beings, the cycles happen because of our behaviors, right? And when the market crashed, there was a panic. People right now believe that the market is coming back or so on. But my question to you is that when the market crashed, and I assume you are also a normal human being, how did that investment decisions that you're making at that point of time, has it changed right now, or is it the same kind of nervousness and panicking? Or let's say, I'll not use the word panicking, but let's say there is a sense of course, if there is a blood in the street, there is a sense of panic. People become more cautious. Let's put it this right way. The investors become more cautious, right? So are you still? Of course, I don't want to say that you're not cautious in investing, but the point is that has this view been changing among you or among your peers, with whom you are investing right now? Just so that the audience, especially the CEOs who are watching, can heave a sigh of relief and go for a nice summer vacation.
Yeah. Listen, the market crashes and market sentiment is very important, but it has different effects depending on the vintage of your funds. Now, as we all have different vintage because we manage funds at different stages. For example, a market crash is very bad news for a fund that has been already invested, and you need to exit companies because you're going to sell the companies for lower valuations, right? But if you look at it in the opposite way, because our industry is a bit counter-cyclical, if I'm in investing mode for my last fund, for example, then the pre-money valuations are lower as well. And you may enter, and then if you wait for 4 or 5 years, you will get the time window to exit those companies at the highest point precisely. So it's a blessing. So it is never good news or bad news. It just needs a special, I mean, you need to manage carefully and manage well. Okay. And every fund needs a different style of management. If I'm finishing the fund, I am at a disinvesting period. It's one type of management. If I'm investing, it's another type of management. But I can tell you that all market crashes have underlying opportunities. You just need
Correct.
to look carefully. So I'm not scared about the market crash by itself. Of course, it has an impact, and I need to manage it accordingly, but they typically bring some opportunities as well. So it's all about management.
Super, perfect. Luis, thank you very, very much for your time. For all the audience, if you're planning for summer vacation by the beach, you can keep reading this. And most probably, I think, the only chapters that are left is, on algorithmic thinking. And so unless I go through it and I have developed my questions, maybe we can connect later if possible. But till then, I wish you a very nice summer. And thank you very much for coming.
Thank you, Sora, for having me. It has been a pleasure, as always. So, yeah, have a great summer.